There it is. There it is.
That's right.
What's going on, mister?
Well, it's good to be back on the podcast from a little European vacation, which I want to say was spectacular, by the way. Whole separate issue. Almost got my ass left in Rome. It's a whole story. Like I won't bore everyone with the podcast here, but it was a fun and exciting adventure. So I'm glad to be back. And by the way, thank you to Mr. Coffman here for holding down the fort on the podcast while I was gone. Much appreciated.
Oh man, that was pretty rough. I really do enjoy I love doing this stuff, but man, it is so much easier when you got people to just kind of bounce things off of. We kind of go a little bit off the cuff, you know. But yeah, what do we got? We don't really have any questions from last week. We had a little bonus podcast the other day.
Oh
Um,
yes, we should mention the bonus podcast from yesterday, which you can find in the links in our channels and everything too. That was very good. It's a sub two deal analysis. So
yeah, yeah, we actually walked through very very recent. In fact, I closed on that property yesterday, but walked through a very recent subject to deal. Didn't quite have time to do the fix and flip one. The one that we did talk about was a buy and hold, long term seller finance, and then we're going to try and get to our fix and flip that we've got going on right now, but um, we weren't quite able to get to that one. That one's really interesting too.
yeah, that's a good one too. Yeah.
It's a really good one because there's a lot of juice in it, and it was just a really really good deal. So,
Yeah.
so have you got anything before we bring our guest on?
I do not. We just should just intro our guest today. Very excited, by the way. It's very excited. I always like what are some of the most frequently asked questions we get from our like students and other real estate investors is like taxes. What can I do? Like what's this
Tax consequences.
1031 exchange? Yeah, how
Yep.
am I getting screwed? What do I need to do? Blah blah blah. Well, I have a treat in store for you today. We have our accountant, right? The Sub 2 Empire accountant, who is Miss Kathy Ayres, is with us today. And so we would like to welcome her. And obviously, we're going to get to a lot of real estate investor related tax questions with Kathy. I know she's excited to hear that. But as we always start, though, we just want to know because we know you. Like I've known you for what 20 plus years now. You've
Right.
been my accountant for 20 years now, and
Mm-hmm.
Jeff's come on board as a client and Sub 2 Empire and all that stuff. So we're very excited to have you here. So just tell us a little bit about yourself and I'm an accountant and what's your business look like today, all those sorts of things. So tell us a little bit about Kathy Ayres.
Okay. Well, thank you so much for inviting me, guys. I really appreciate it. I'm a novice. This is my first time doing something like this, so I hope I don't screw it up.
You can't. That's impossible to do. We're gonna do plenty of that for you,
Yep.
so don't worry.
Yep.
Okay. All right. Well, my background is I'm St. Louis native almost all my life. Eureka High School, the St. Louis question. So, where'd I graduate? So I've been around, St. Louis County area and Jefferson County area all my life for the local folks. I got my accounting degree at University of Missouri St. Louis, and from there, I went into what was then known as the Big Eight accounting firms. That'll date me, tell you how old I am if anybody knows about those things. What the one that is now known as Deloitte. Spent 5 years in the audit world, then came out of Deloitte and spent the next many years in various corporate finance jobs in some large companies in St. Louis, what used to be called Monsanto. It's now part of Bayer. Company named Bunge, which is a big grain commodities company. Southwestern Bell, back before it went back to being AT&T. So learned a lot in corporate finance. And then along in there, I started on the side. Everybody, when you're a CPA, for some reason, they always think you know about taxes, even if you're in the corporate world. And so I started saying, well, let me learn about taxes. Let's do something with that. So I started a side gig where I was, starting my tax business and accounting business. And then I came out of the corporate world in 2009 and not on my own doing. Monsanto quit me, is the way I say it. I got laid off with 18,000 of my closest friends, or 1,800, whatever the number was. But anyway, and so anyway, that's when I hung my shingle out, and I said, okay, if I'm ever going to make a go with this thing and make this full-time tax gig work, it's now or never. So I began this work full-time in 2009. So that puts me in at about 15 years. And from there, I've just been growing the business through some acquisitions, some word of mouth, a lot of referral business, yes, networking, and acquiring from some of my colleagues who have been retiring. And now the business is into a full-scale CPA office. We have 6 of us on staff here, grows to 10 during tax season. We offer all manner of personal and small business corporate partnership tax returns. We also have a full bookkeeping / accounting business where we support probably 50 clients in their monthly accounting work. We have a full payroll offering too. We offer payroll services to about 30 or 40 clients. So I like the idea of having everything under one roof. And so we do offer that for many of our business clients that want that. And of course, we still service a lot of personal clients on the tax return side only. So, so that puts me in business for, 30 plus years overall. And that's kind of where I am today. So what else do you want to know?
So how was that? I'm very curious about this because everybody that goes into business for themselves, they have their own kind of their own experience.
Mm-hmm.
Was that was that just something that like you were gung ho about, or was it something to make that move from corporate to essentially self-employed?
Mm-hmm.
How was that for you? Was it nerve-wracking? Were you excited about it?
Extremely nerve-wracking and exciting. I think it was kind of in the genes. My dad tried it a couple of times, and so I saw it growing up. Tried having his own business. He ended up, not being very successful. And so I saw some of the good, the bad, and the ugly. And it was basically the nerve-wracking part is, having seen the challenges. But the exciting part was, being in the corporate world for, 20 plus years, there was a lot of stuff that just, gave me a bad taste. And so it's like, it's exciting to get out on your own and say, I don't have any bosses, but I really do. I have, 2,000 client bosses really, but it is exciting, and it's just a drive and a passion that you have that, to make it work. And willing to go to whatever lengths it takes to, learn what you need to know. And like I said, before we joined, you never knew you had to be your own tech guru too, when you start off in your business by yourself. And learning all of that and developing all your own procedures and policies. And the good news is that coming out of the corporate world, I had a framework for a lot of that, and that really helped. But nowadays with the internet, there's so many places that you can get some guidance on some of that framework.
You can start a CPA firm with ChatGPT now. I don't know if you know that. No.
It's in full force. That's right.
Yeah.
Yeah. Mm-hmm.
Yeah. Well, at least you had one leg up, because when I got started in business for myself, first of all, I didn't file taxes my first year in business. I didn't know what to do. I had no idea what to do. So, I mean, you had a leg up there. Like, you knew exactly what to do tax wise.
Well, not always, because it's all business different in the corporate world. When you get into the small business world, it's very different, and there's a lot of nuances to it. And I will tell you, one of the things that keeps me going and keeps me fresh is I am required as a CPA to have 40 hours of continuing education a year. And so I have to go to conferences or attend webinars, and it, and not only do I have to for licensing purposes, but I just have to stay on top of things. So
Sure.
that is, that's huge in this business, especially with all the changes that come along.
Well, so I have some questions about that you say staying on top of things, and also too, I want to say for the record for everyone too, I ask a lot of questions of anybody that's my it's my accountant, financial advisor, or whatever. Like I'm sure that shocks a lot of you watching this. I ask a lot of questions, and there has never been a time that I can remember in 20 years now that I didn't ask Kathy a question that she didn't find the answer to. And a lot of times I wouldn't have expected her necessarily to know the answer off the top of her head, but she has found the answer. So her dedication to continuing education is true, not only because she has to, just because she, just me as a client asked a question and you found out, found the answer to it. So
Right.
I appreciate that as a client. But I'm just curious to know. So you mentioned all the new stuff. So what's coming? Like we're going to get to the real estate investing stuff on this, but it just generally speaking from a tax perspective, from the continuing education you've done, like what's on the horizon? What bullshit are we going to have to put up with as as tax people and business owners and all that? Like, what do you see? Is there anything that you're concerned about or that you see as potential issues coming down, just generally speaking? Then we'll get to real estate specific.
Okay. Well, generally speaking, so right now we are still under the Trump 2018 tax law that was passed, where all of the rates were reduced by 3%. And that expires at the end of 2025, absent further legislation. So the good news is that, standard deduction came in, higher standard deduction came in and caused a lot of people to not have to itemize deductions anymore. Rates were very favorable. The span of income within rate bands is very nice. The 22 and 24% tax brackets cover people up to almost $400,000 of income. So that's good. What is most concerning right now to me is there was a wonderful thing that was put in place in 2018 that was called the qualified business income deduction for all our small business owners. And so 20% of their net business income was deducted. We took net business income of $100,000, and just as a perk to business owners, they got an extra $20,000 deduction off of that business income. And we've been living with that since, for the last 6 years. And business owners, if there's not any other legislation, all of a sudden in 2026, you will change nothing about what you've done, but you will lose a 20% income deduction, a deduction from income, without changing a darn thing of what you've done in your business. And that's going to be a hard one to be sitting across the table with clients and explaining that to them, that it's a tax law change. So it's one thing that, I'm concerned about. And of course, we're in an election year, and we got no idea, what's going to happen and where we're going to go from there, depending on who is in the White House and who's in Congress and whatever changes might be coming. So I think that obviously this year is nothing's going to change, but I think next year we could see the beginnings of some massive changes coming.
Oh, you stabbed me right in the heart.
Yes, indeed. Yeah, but I'm sure, as you mentioned, though, in 2025, there's going to be all kinds of continued chaos, let's just say, especially as it relates to our so-called elected leaders that are looking out for our best interest, right? So we'll see what happens with all that. You know me well enough to know that I am dubious at best about any of that, and my sarcasm is thick as it relates to those people.
Right.
So
The other good thing, though, I will say, I do have to put a plug in because I know that we have seen our fair share of erroneous notices coming out from the IRS over the past few years, and the inability of the IRS to keep up with correspondence and getting these notices cleared. And of course, it always becomes the accountant's fault. It's always our fault. We did something wrong. But usually it is something very minor that can be cleared up, but the time to get it cleared up has just been dreadful. We do see that getting better with the funding that the IRS has gotten. It's a double-edged sword because we're seeing them be more responsive now to our issues and problems that we're trying to resolve for our clients. However, the other side of that coin is, we are going to see more enforcement coming because they do have more boots on the ground. And so we're going to be seeing more audits and even more, question and scrutiny over, the tax returns that are getting filed, starting now.
So Kathy, I just want to make sure that I heard that correctly. So you mean that the 86,000 additional IRS agents aren't just going after the rich 1%, as we were told? Is that what you're suggesting to me?
Yes,
You mean
I'm
they're actually going to be auditing us, right?
They're going to be auditing.
Right. Yeah.
They're going to be, they've stated, yes, under the Biden administration that they will be going after the over $400,000 income folk. But the other thing that they are, and this will lead into another question that you guys posed to me on my questionnaire. They are looking also toward a lot of these complicated LLCs and a lot of stuff that the folks in the real estate industry are dealing with these layers and layers of LLCs. And that's, one reason for this beneficial ownership reporting that has come out now. If I can jump to that under the Corporate Transparency Act, and that, that is, but the IRS will have access to that information, but that information is not coming from the IRS. They are not asking for it. It is the Financial Crimes Enforcement Unit that's asking for that info. And they are primarily looking for, the offshore, hiding of money, and the offshore and the laundering of money. But make no mistake, once all that information is reported to BOI, I'm sure the IRS is going to be using that as well for, who to start targeting for audits.
You know what? I compare this to when I was a kid. Do you remember when the seatbelt laws came into effect? Do you remember that?
Yes, I do.
It was in the early 80s.
Mm-hmm.
And I remember as a kid thinking, driving with my dad, driving down the road, like, how can they make someone, wear a seatbelt, first of all? But then as I got older, I realized, and I promise I'm going to relate this to what you're saying. I realized that was nothing more, because remember, it was a non-moving violation. They could only
Mm-hmm.
ticket you if they pulled you over and you weren't wearing a seatbelt. Well, now it's like, if they see you driving down the street. So I relate that to what you're saying, because this is just going to get bigger. It seems like any inch that you give these folks is just, they just expand it and expand it. Before you know it, LLCs are going to be useless. I mean, I don't know. Maybe I'm not being giving them the credit that they deserve, but or if they deserve credit. But yeah, I just can't understand. It's like LLCs were one of the great tools that we had. So
And I think they're still a great tool, and they'll continue to be a great tool. And the people that are doing things ethically and reporting completely will be fine. But we, as we all know in our world these days, we all suffer because of what the criminals do. And so, every time I have to take my shoes off at the airport, I think about the Unabomber, and I'm like, because one guy, did something, we have to take our shoes off, so it's because, if we're all doing things, and as a CPA, I will continue to do things ethically and within the law. I will always, try to work for the best interpretation and the best use of, for my clients. of the laws and regulations we have. But I'm not going to do anything outside the law. And, as long as we operate within those parameters, even if we get audited, we'll be fine. And, I've been through audits and with zero changes, zero adjustments. And a colleague told me one time, well, that means you're not pushing the envelope far enough. And I'm like, well, I don't know about that, but it's because of the crime that, the good people end up having to do what we have to do. So
That's crazy.
So two things. First, I'm going to just do a shameless plug for like as Jeff mentioned, like this whole Corporate Transparency Act and the LLCs. That's the reason you use land trusts. So go to our website, get our land trust stuff, and start using land trusts as a way to protect yourself, especially as a real estate investor. That way you don't have multiple LLCs that will almost automatically trigger an audit. So the other thing about the Corporate Transparency Act is, and you're right, that the whole rationale behind it is to stop all this offshore loading of money. However, just me as the dumb guy reading like the fine print of the law, not that I've read every page of it, but I've probably looked at it more than the average bear. It really has little hope of stopping what they intend to stop, because all the rich people, the 1%ers or 5%ers, as we call, are still going to get around all that.
mm-hmm.
But whatever, right? The average person and all of us still have to, abide by it. So I'm just asking you, just for the benefit of all our audience, Kathy, what exactly are, to the best of your knowledge as of right now, what are the reporting requirements under the Corporate Transparency Act and the due dates and all that stuff, if you don't mind?
Okay, so sure. So any LLC that has been created with a state agency is required to report the beneficial owner information, which means any owner that has either 25% or more interest in the entity, or you can have less than 25% interest, but still really be, a driving force in the entity. And all you have to do is report that owner's name, address, not even your social security number. It's just the owner's name, address, point of contact. I think there's a phone number required. And that's it. I did mine in 5 minutes last week. I went on and did mine for my S corporation. So all LLCs created with a state agency, if you were created before the end of 2023, you have until the end of 2024 to report in for your initial reporting. Ongoing reporting is going to be any changes. They just want to know where to find you. So if I move my home, I need to go in and, give them my new home address. If I admit another person, I'm 100% owner. If I admit another person to my S Corp, I have to go in and if that person's 25 or more %, I have to report that additional owner. Any LLCs created within 2024, you have 90 days from date of creation to report that new entity. And then it'll be 30 days going forward. Starting in 2025, you'll have 30 days to report into BOI when you create a new entity. And I'll tell you, I'm not very concerned. I know I've got LLCs we've created in 24 that we haven't reported in yet, and we'll report them by the end of the year. I'm not too concerned about, any issues with reporting as long as we get it in this year. So that's the requirement. And it's driven by the Financial Crimes Reporting Unit. And it's a real easy. Go to FinCEN, Google FinCEN BOI reporting, and you go in there and you can easily fill out the information. And you'll find, a lot of people will find that most of it doesn't even apply to them.
Very good.
So I have, sorry, just a quick follow-up question. There are current lawsuits against this law, by the way.
Right.
And so I'm just curious, in your probably in your continuing ed, I'm sure this was probably a big topic this year in your continuing ed, or maybe. Was there any conversation about how this federal requirement is opposed to the states, right? So, like, for instance, Wyoming, Nevada, Delaware, who have very good privacy as it relates to their LLCs or their business entities that you set up in those states. And so they're non-reporting. Like, you can't find out the owner of a Wyoming LLC, right?
Mm-hmm.
Unless they happen to just put themselves out there necessarily. But now they'll be required to report it under this federal guideline. So how are the states? Has there been a discussion about that, about the states and the law? And that's basically what the lawsuit is about, is that, they're
Mm-hmm.
overriding the state's authority and all of that. How do you see that? Has there been any discussion about that? I guess is just my question.
Unfortunately, I have not been involved in any of those conversations. We've had the conversation that's been in my world has been about whether or not the CPAs should be even doing the BOI reporting.
Oh,
And,
right. Should be the individuals. Yeah.
is it bordering on practicing law? And so I haven't been privy to anything that, but you raise a good point about the states. And what I don't understand is why it is, falling to the individuals to report this rather than just the federal government going to the states and say, hey, give us this information. You've got it.
Right.
Why do the individuals have to even report it? And that's to me is the bigger issue. But yeah, I think that's a good point about the anonymity. But here again, they're trying to find, these dark corners where, the money's getting hidden. So Big Brother's going to keep trying.
Indeed.
They'll get it. They'll get it. They definitely will. Because,
Yeah, they will.
because we're, I don't know. I'm not going to get political, but, we're just minions. We're just out here just, I don't know. It's crazy. So, I know we're about a half an hour into this. Can we get on the real estate side of this? Are you guys good with
Let's
that?
do it.
Sure.
Yeah. So the very first question I have, I don't have a sheet or anything, but this is something that always seems to come up, especially with new people. I mean, I had the same problem when I got into business for myself. But what are some of the most common mistakes that we're going to see with people that maybe have never run a business or owned an LLC? Maybe they've been a sole proprietor prior to actually owning an LLC. What are some of the common mistakes that people tend to make when they start a new business, as far as it relates to taxes or just money management in general?
Well, the biggest issues we see are just good record keeping track of what pertains to the business versus what pertains to your personal life. I always recommend people, especially when you open an LLC. Okay, in the state of Missouri, that gives you the ability to go open a bank account under the name of that entity. Go open that bank account. Go get a credit card if you need it, and a debit card, and keep the business income and expenses separate from your personal life. Unfortunately, in some of our bookkeeping clients, we spend a lot of time separating out their personal spending, so that we don't, capture that erroneously on a tax return that we shouldn't be, taking personal expenses on, and I will tell people that depending on how your entity is structured, that's still your money. You fund that entity to get it started. Okay, that's fine. As the company is making money and you've got cash, you're taking the cash, and that's okay most of the time. Put the cash over in the personal account to pay the mortgage and pay the electric bill. But when you go buy that piece of property, or whatever business you're in, keep those financial records separate. And we provide all kinds of checklists and tools to clients for, acceptable deduction items. And this is a little bit counterintuitive, but I tell people, if you're not sure if it's business, go ahead and put it in there. Tell us what it is. We'll take it out if we can't use it for your tax return. So that's, record keeping is one of the biggest ones.
Yeah, I was kind of hoping that's that's really was kind of what I was digging after. Yeah, because I've had folks, maybe even had students that would ask, how do you take money out of your business? It's like you just
Write yourself a check, or you
write
transfer it.
transfer it and document it. That's
Yep.
it's that simple.
It's exactly right. Yep.
You're not,
Mhm.
especially with an LLC, you're not, there's no real requirement for you to take a, if you were an S corp or something, and then you had
Right.
to, you had to take a quarterly income or show a quarterly income. With an LLC, it's literally just, for me, it's when I need it, I take it out and I document it.
Right.
I categorize it and classify it.
Exactly.
Are there any, sorry, Ken,
No, go ahead.
Get me on a roll with this stuff.
That's absolutely, go right ahead.
Are there any, do you have any kind of, I know you said you had a bunch of checklists and stuff like that. I'm not sure, I'm not sure those are publicly available. So I will ask you this. Are there any resources that you could point people to, maybe some good reading, some really good reading material, or even getting down to, like, say, a chart of accounts, like, and is there, because not everyone is, I think probably just a lot of people like me that when I got into the accounting thing, I just went right over my head. I just was just terrible at it. I still am, and I'm sorry for that. But so for me, it was like, well, how do I classify this? Is there some sort of resource maybe online that people maybe people can reference that would show them how to actually classify and categorize their expenses and their income?
Sure. Well, we use QuickBooks online, and we use the desktop version of QuickBooks for our clients. And QuickBooks Online has all kinds of tutorials that you can go access free of charge just to see about the product. You can see sample companies there. You can see, again, the charts of accounts and how you would categorize and label things. That would be one resource. And believe it or not, the IRS website, irs.gov, they've got a lot of good, publications for, types of deductions and limitations on those. And there's, I think it's called Pub 15 is the one that's kind of getting your business started. And also most states, Missouri, I don't know, I'm guessing we're reaching other states here as well, but your state Department of Revenue should also have at least in your state, Google starting a business in Illinois or Missouri or Wyoming. And, there should be good resources out there for giving you guidance as far as your filings are concerned and what kinds of things you have to know to do business in those states. And then the taxation in the state and what your requirements are there. But the general overall, federal requirements, there's a lot of great information on the IRS website now. They've done a lot to improve it. And I don't work for them. They've done a lot to improve it over the last several years.
Okay. All right. Oh, sorry. I was got a little lost there. All right. So I forgot what my next question was going to be. I had it on the top of my head, and I wrote it. I started to scribble it down, but I forgot what it was going to be. But
if you're all right, let's talk a little bit about entity structure, if that's okay.
Sure. Mm-hmm.
So as real estate investors, like way back when, we're always told, and for the most part, like Jeff and I are believers that the LLC is kind of the best, most flexible entity, especially for a real estate investing business. Like maybe you have an LLC for your fix and flip business, maybe you have an LLC for your buy and holds, or you're like me and I mix everything around because I get different business partners in, and then you got to straighten me out, Kathy. But all those sorts of different things. When would you say, and you mentioned an S corp, right? Mm-hmm. And some real estate investors do have S corps or even C corps. We generally don't do that. Like I've in almost 25 years now of or I guess 20 years now, having like an official LLC and for real estate purposes and all that too. Like I've never seen a need, or I've never had a circumstance, and you and I have talked about this, to switch that from a real estate business to an S corp or a C corp. What do you recommend there to stick with the LLCs? When would a real estate investor maybe want to switch to an S corp or a C corp from the different clients you have?
Okay, so yes, I agree with you. The LLCs are your most flexible when it comes to the real estate business, and you're going to be, you can use them in so many different ways. The S corp, the requirement that the S corp comes, or that the IRS requires for the S corp owner, is that you have to take a salary. So in the real estate investing business, the only time I really think that you need or you might want the S corp is if you've got the buy and hold, and you're doing a lot of management, or if you're doing management for other people. And you can take a salary out of that business, because you've got to take what is considered reasonable compensation for, the work that you're doing. So that is going to lend itself to something that's going to be pretty steady, and not a lot of, ups and downs. A lot of time, especially on the fix and flips, you're going to have a lot of up and down of your income from year to year. So the S corp, I think, is going to be very limited in that, in the whole industry, and the LLCs are going to be much more flexible for you.
And what is the, let's say you do have that buy and hold business, you have a regular monthly cash flow and all this stuff, and you do elect to file as an S corp. What are the benefits? Maybe just briefly go over some of the tax benefits of filing as an S corp.
Okay, so the S corp, the main benefit is that salary that the owner takes is deducted out of the S corp income, as well as the employer payroll taxes that are paid on that salary that the owner takes, and that's all deductible in the entity. When you're just the straight LLC, you don't get the deduction for your what's called self-employment tax. When you're just the straight LLC, you don't get that deduction out of business income. So you end up paying more in taxes and less deduction when you've got that LLC versus the S corporation.
Is there an income, maybe not a requirement, but is there maybe a recommended income where you should start thinking about maybe electing to file as an S corp?
When my guidance to clients is usually, if you think that bottom line from that entity is going to stabilize at about 50 grand a year. So after, all your rental income comes in and all your expenses go out, or your management fees, whatever, that you're collecting. If that bottom line is about 50, that's when you start. I mean, you're going to get a little bit of savings below that, but the numbers, depending on where the taxes are at any given time, you're saving yourself roughly about $4,000 in taxes if you start that S corp, when you've got that bottom line of about 50 grand. And it's going to stay that way, because you have administrative costs with that. You've got to have somebody, either yourself or somebody else, running payroll. You've got to get payroll tax IDs. You've got to report that in quarterly. You've got to withhold the payroll taxes and pay them in either quarterly or monthly or something more frequent, depending on the salary. So there's some administrative headache that comes along with that.
Is it $4,000 worth?
Well, depending.
I'll just stick with an LLC.
Right. Yeah, because you're paying somebody, or you're doing that yourself. So, right. And that's kind of where I tell people that it makes sense to start turning it on and start using it. And especially if you're in a high growth, industry, or if you're just going gangbusters, and that next year you're going to be even doubling and and growing every year. So that's when we usually start looking at that with our clients.
Okay.
Just to clarify something too, because what Jeff said is that there's two ways to be an S, right? You can ask as an S corp, and you can elect for tax purposes. So that's what Jeff mentioned. So that's what we would do. Like, as real estate investors, we would recommend starting your LLC, and if you want to convert it, just change how you're going to file it. Now, correct. That comes with the thing, because you and I have talked about this, Kathy. Like, I'll just keep going back and forth, right? Depending on how it benefits me too. But you can't, right? Once you change the election, you have to stick with the election for tax purposes.
Right. Yeah. And you actually, your S corp, it will start as an LLC, in the state of Missouri, especially. And then that election is a federal election to be treated as an S corp. Yes. And once that election's been made, then you stick with that election, and until you revoke it, which you can revoke it, but you don't want to you can't do that every year. They won't allow that. You can't go back and forth. So yeah, that S corp election, and once people do that, usually there's very rare situations where it gets where you revoke it.
Yeah, if I, actually, I have a couple of follow ups to that, but one of those is, I've got a friend. He's actually, I'm not sure if I should say this on this podcast, but so I actually put him in touch with you. You may not know this or not right now, but his name's Andy. His name's Andy.
Okay.
He lives in Arizona.
Yes.
And
yes.
So,
I've spoken with him. Yes.
Okay. Mm-hmm. Andy's a great dude, by the way. You're going to love him. He's extremely organized, very data driven. So you're going to love him. But I guess the question is, for you, are you taking on? I mean, are you just focusing on folks here in locally? Or are you kind of taking on people as they come in? And what is that like? Because don't you have to understand kind of the tax laws in every, all these different states, or do you have like software that does that for you? Like, how do you manage that?
So yes, in fact, we do have clients all across the country. Yes, I am always accepting new clients. Right now, though, I will tell you that, we are referral based. I'm not taking cold calls anymore, but if anybody that is interested in us, mentions that they've heard me on this podcast, we would absolutely be interested in speaking with you. And yes, you do have to be aware of, all those different state tax laws, but I've got wonderful software that, is very good at getting, and I can file in all the states that have income taxes. And the software is great about making sure that we, do everything correctly for the states. And most of them are pretty similar. I don't know of any that are really, really out there when it comes to the state tax law versus, Missouri and the ones, Illinois that I'm most familiar with.
Okay. So we have a particular, well, I don't know. I've never explained this to you before. I don't know if, I'm pretty sure you probably never heard this from me, but when I first got started in this and I was buying these houses, I would buy subject to. So I would go in and I would assume the debt on these mortgages. But the way that I would do it is I would create a new LLC for every single one of those properties. It's very common in this industry for people to do that. In fact, we still recommend it if you're going to buy a property that you pick up subject to. We still recommend that if you're going to do it in LLC, it's got to have its own LLC. It's got to have its own bank account. Just simplifies things. However, at the end of that, I told you that first year my taxes were a mess, and by the end of the second year, when we finally, after all the extensions and everything, when we finally filed, I owned 21 different LLCs.
Yep.
And then they were Missouri LLCs. And so I had to, or at least the CPA that was doing that stuff at the time, I had to file a return for every single one of those LLCs. So right now, and I want to get your opinion on how we do this now, because that taught me a valuable lesson that I needed to simplify my life. And so the way that we manage this now is we actually, Ken mentioned it earlier, we put all of our properties in trusts. We'll create a trust for it's literally off of this printer right behind me here. We create a trust, and our LLC is the beneficial owner of that trust.
Okay.
So now we use the trust as just a pass-through entity. Are you seeing any, maybe any of your other clients, or is anybody, any of your real estate clients, that is, are you seeing any of those folks structure these things? And is that a structure that, are we missing anything? Maybe you can educate us. And are we missing anything in that structure?
Well, you guys are probably the most advanced when it comes to, the clients that I'm dealing with. I've still got many that are doing the multiple LLCs, and not using the trust as a vehicle. I don't think you're missing anything. I think you guys, have closed the loop on that, I guess is the way to say it. Um, One of the things that I see, and that might make some sense in some instances, is that you might have an LLC that holds all of your fix and flip LLCs, another one that holds all of your buy and hold LLCs. So you simplify yourself a little bit there, and the reporting and the filing. Because then you're still going to be filing a lot of returns, but at least they're going to be kind of lumped together, instead of just 21 LLCs all over the place. And so to my knowledge, and I'll tell you, you guys, like I said, you guys are pretty advanced when it comes to this stuff. And so I don't have anything, I don't have any magic pill there or anything better to offer you than what you guys have already identified.
Okay. So if we're talking about this, I don't want to get too crazy into it, but for the folks that are still using LLCs, because we're dealing with our demographic, our audience is creative finance folks. So those folks that are still using LLCs to purchase each one of these properties, these creatively financed properties, you talked a little bit about having one LLC own those multiple LLCs. Is that something that the average Joe can do? Is that something that and I forgot what that's actually is. That's not a series LLC, is
Umbrella LLC.
Yeah, an umbrella.
it? Okay, umbrella. Okay, okay,
Yeah, and the average Joe can do that. Sure. Yeah.
okay.
I mean, and we open LLCs all the time for people. So, and I always make them very generic when I open them. I'm just like, all business legal within the state of Missouri. So, you can use it for anything. And again, that goes back to that flexibility of it. So,
Gotcha.
And so I just like to note too, so your umbrella LLC is kind of similar to us just using trust and then having one LLC be the official owner of the trust, just kind of in reverse.
Right.
But don't forget the previous conversation we had about Big Brother and the Corporate Transparency Act. Right? That's the number one reason. Like, I hate, I'll just say it. I hate the government in my business. They have no period. So using a trust prevents that, right? Like, it keeps me arm's length, one more arm length away from Big Brother.
You're right.
That's why I do like the trust. But from a tax perspective, yes, I like your umbrella LLC. I just have another quick question though, to tail off that. So let's say Jeff had his 21 Missouri LLCs and he said, well, Jed, I just need to get all these under the one LLC. I said, we use trust now, but let's say he did that. And let's say he said he had 21 Missouri LLCs, but let's say he wanted to create that umbrella LLC in a very favorable LLC state like Wyoming, right? No state income tax in Wyoming. There's no state income tax in Nevada and all that things. So if the properties were owned and the underlying LLCs were here in Missouri, and then he created, let's say, that Wyoming umbrella LLC, which has no state income tax, does that really mean he's not going to pay any state income tax on that? How would that work since the properties are here in Missouri, which does have an income tax? So I think that's a misnomer for some people too. Right. So how does that actually work for tax purposes?
That actually works that because of the property is in Missouri, you will be paying the Missouri state income tax on, the income from that LLC or from that property. And that is a big misnomer that you'll never pay state income tax. If you buy the property in Wyoming, great, or Nevada or wherever. But if you still own that Missouri, then you're going to pay the state income tax in Missouri. I actually have a group that I'm working with that they're in Connecticut, and they had a large gain in 2024 from property in Illinois, and and the Illinois Illinois is dinging them a couple of different ways because they're going to probably end up paying more state income tax in Illinois than they would have in Connecticut. I haven't run all the numbers yet, but because Illinois has a couple of different ways they tax that property sale. So anyway, the bottom line is the tax is going to come with where's that real property owned.
I just spoke with you about that yesterday because I do have.
That's right. We talked about that yesterday. Yes.
Yep.
Yes. Mm-hmm.
Yeah, I was really bummed out after that conversation, to be honest with you. No, I'm kidding. No, yeah, I know there are a million things I want to ask you, but I just can't. I'm having a tough time just putting them all together. And when I think of one, it just disappears because I'm so interested in what you're saying. So I apologize.
Oh,
but
wow. I'm flattered. Well, what we got to do is you got to make your list then, Jeff, and you have to have me come back sometime. So
yeah, for sure. Yeah, this is my weak spot for sure.
Not January through April.
Yeah, maybe we'll just do a Q&A too or something.
Or you can do right. Sure, we can do that. We can do that. But thinking about it, if you just kind of think about this from what makes sense, Missouri is not going to forego the taxes on activity that happens in Missouri. No state's going to. So, so that's just kind of the gut check on the whole thing. So,
yeah, I know I've been told before that there are exceptions, or there are certain rules when it comes to owning property. Like if an out-of-state owner owned a property here, but my understanding is that if it's commercial use, if you're making money on it, it needs to be, you have to file or register as a foreign entity here. And is that something that you have to do? Do you have to register as a foreign entity to file a return in another state?
That's a legal question. I don't know the answer to that one. I'm sorry. I'd have to look that one up.
Okay. So. That's fair enough. All right.
So just another
rant.
Yeah, just another. Well, you know me. I hate people telling me what to do. And all that stuff too. The government should be for safety, security, and infrastructure, and beyond that, then it's just a violation of my privacy. So, what mentioned about real estate investors? You mentioned good record keeping about business owners and everything, but specifically as it relates to real estate investors too, what are maybe 2 or 3 other things or common mistakes you see or pieces of advice you would give, especially for that new real estate investor starting out? They got their LLC. What are a couple other pieces of advice you would give the real estate investor specifically?
Sure. Well, and it's going to differ based upon the buy and hold or the fix and flip. A lot of real estate people, when they're buying and holding, they tend to want to write off a ton of stuff every year. All those things that they're doing, if they're making major repairs, and you can, there's nothing wrong with that. You can certainly do that. That's perfectly legal. I encourage people to take a look at, okay, yeah, you're going to buy and hold this thing, but you're not going to own it forever. Someday you will sell it. Let's make sure that we capitalize the things that we should capitalize. So if you put that new roof on, yeah, you can expense that new roof, but that may not be the best way to do it. Everybody is always, most people, I should say, are looking at how do I save taxes now? The things that you got to worry about on those hold properties is, okay, but someday you're going to sell it. And if that thing appreciates in value, 1x, 2x, you're going to be hit with a big capital gain down the road on that property. So let's be cognizant of what we want to expense as repairs versus what we want to capitalize. That's one thing. And the other thing, and then on the fix and flip, of course, everything that you do to that property, you want to increase the basis of that property for that flip. So you don't. And so, you're going to load as much into the capital assets as we possibly can. And so those are 2 considerations. We haven't even talked about the 1031s, which, and that all again on the fix and flip and even on the buy and hold, that, the 1031 consideration is, it's a wonderful vehicle to kick that can down the road on those capital gains on those properties. And just be mindful. It's not always about today's, tax break. It's about, your long-term goal. I have a quick little story. I have family members that have been real estate investors for many, many years, have owned apartment buildings and condos, and they've been doing 1031 exchanges for many years, and they're both getting up in age now. And now they're trying to offload their properties, and, they're feeling the bite of the gains that have been deferred for all those years. And, I've told them, I said, you kick the can down the road for, 20, 30 years, and now it's time to pay the piper, unless you want to just, hold this stuff until you're gone. And then the kids get it, and then they can turn around and sell it immediately, but it's not always what's the best, saves me the most taxes today. What makes the most sense in the long-term scheme of things as well.
Well, you should put in a plug for us with that they can defer their gains by seller financing it directly to us.
I was going to say, if you only knew someone that would be that does seller financing,
you go.
As a
all right
profession.
then. All right.
And we can control those gains that they realize year over year.
Right.
By how we structure that seller financing. So.
Right. Yeah. Absolutely. That's true too. Yeah. Cause that seller financing is a wonderful thing. Yeah. And I've got some people that, we've been working on some sales, and it's like, yeah, draw that gain out over a few years by financing that sale too. That's a wonderful vehicle as well.
I want to stick on the seller financing thing for me, because that's I think everyone that in our little bubble here knows that I'm the worst landlord on the planet, and I just hate rentals. I just hate them. I understand the tax, I understand the tax ramifications of that, but can you explain maybe some of the different tax consequences of owning rentals versus selling a property on seller finance, and how those two different types of structures might be taxed?
Well, if you're owning the rentals, that's all going to be ordinary income to you. Okay. On the fix and flip or the seller financing, there's going to be a component that, depending on the real business that you're in, there's going to be a component that's ordinary income. But there could also be some that's capital gain, which is more favorable right now. Rates on capital gains are, 15 and 20%, not, 22 and 24%. But we have to be very careful about how we're qualifying this if you're qualifying this as a business that you're in. Because if you're in the business of fixing and flipping, it is ordinary income. If this is a one-off thing that you've done, once, and you're not going to ever do it again, then it could very well be just a capital gain item. So, but I think most of the people that we're talking about are in this business, but I could be wrong,
Yeah.
Is that what the kind of discussion you're looking for?
Yeah, sort of. So like what really kind of what I'm thinking was, I know for rentals, we get to take depreciation on the property because you're still legal title holder and all that stuff.
Right.
So we get to take the depreciation on it. We can accelerate it. We get, however, whatever the advice of our CPA is, that's what we're going to do. Mm-hmm. But then on the seller finance side, if I'm going to sell a property on seller finance, I'm going to be taxed entirely different. From my understanding, and I'm a layman when it comes to this stuff, but to the tax side of it. But so on the seller finance side, it's my understanding that I do have I have a cost basis, then I have my sales price. So that mm-hmm. difference between the cost basis and the sales price is what I would normally be taxed on. Mm-hmm. Right. So that's my profit. But right. I'm now spreading that out over time. How is that spread? How is that actually taxed? What does that look like on the books?
So that, so if it's a 5-year note on the seller financing, then we get to spread that gain, that difference between sales price and basis over that 5 years. So which is wonderful, because that gain is going to be, 5 years rather than 1 year. And then the only other thing that you have to consider in there is that interest that you're going to make on that note. That's an ordinary income item. And you're going to capture that as income as well. But rather than taking $100,000 gain in 1 year, if you take a $20,000 gain over 5 years, that's a whole lot better to swallow on an annual tax return, for sure.
Yeah.
So yeah.
Which, by the way, we do 30-year terms usually. Sometimes we do balloons, but all of our loans are, first of all, they're unqualified loans, but usually, but they are over 30 years, and everybody knows that amortized loans are heavily weighted in the front end with interest. So if you are thinking about doing seller finance model, sort of similar to what we do, be expecting that ordinary income.
That is true.
You be taxed at ordinary income until they get
that front end load of that interest, right?
Yeah.
Okay. Yeah.
Okay. All right.
Well, you guys are willing to go a lot longer than a lot of seller financers. That's for sure.
I'm long term. I've learned my lesson. The short term stuff just keeps you super busy, and I like the cash flow. I would prefer to have the cash flow, even if it's, with seller finance, you don't have an opportunity to raise that or to increase that cash flow on any one given property because you no longer own it. But to me, that is just so worth the trade-off of not having to be a landlord. I just don't.
Right.
Even if you have good property management, I just find, which is very hard to find. It's very hard to find here, particularly in St. Louis. I'm not sure about a lot of other cities, but here it's very hard to find. So I know I just can't see myself ever going back there. I just can't do it. Pains me.
It's a headache. It's a headache. I've been a landlord once upon a time too. So
yeah. You just have to get good tenants. Like I'm more of a short-term guy than the I like the balloons in there, or I guess we can't call them. I like the full balance payments in 5 or 7 years as opposed to just letting it sit for 30 years. Because honestly, I'm not going to be here 30 years from now, and who's going to be managing that? So I like to do stuff in a little shorter term, but that's just me. So
you like being a landlord too, right? So
just depends. If you have good tenants, I'll take that all the time. But I don't mind converting the tenants. As you know, I've converted the tenants to property owners many times in our properties over the past, kind of the model. So we'll see how it goes. And it is now just past noon. Is there any final questions you have, Jeff, or anything that you'd like to say? We have Kathy's website there, by the way, on the screen, and she mentioned that she's not really taking new clients, but if you mention us that Sub2 Empire sent you over there, she'll certainly have a what's called an initial consultation conversation with you and see what she can help you or not. But any final questions, Jeff?
Nope. I just want to say that I've had 2 different CPAs in the past, and I think they were more kind of like the folks that really didn't know how to run a business, and you guys have done just a fantastic job for us. I mean, I'm not the easiest person to work with, that's for sure, when it comes to taxes, but you guys have been really, really great. So anyone out there that's that watches this later on down the road, give Kathy a ring. I mean, she's just done. I can't say enough. It's so nice to be able, me and my wife don't argue anymore about taxes. It's great.
Wow.
And it's because of you.
Did we save a marriage, maybe?
You did. You certainly did. Yeah, that's for sure.
That's a bullet point that you have to put on the website as services offered,
saving marriages.
through effective tax strategy. Yeah.
That should be your motto. It's
that's a great one.
Kathy Ayres, CPA, saving marriages through tax strategy.
There you go.
That's your slogan.
Like that.
That's awesome.
Well, I
Yeah.
appreciate so much you guys asking me to come along and speak with you today. Thank you so much. Thank you for the nice words and the plugs. And we're willing to help anybody out there that is looking for something that we can offer and that hears about us from you folks. And if there's further questions that we needed to do a follow-up Q&A, or if we need to do another discussion, I'm happy to do it.
Perfect.
Excellent. Thank you very much for being on with us, Kathy.
Thanks
Kathy.
you guys.
Appreciate
Take
it.
care. Bye-bye.
All right, folks. Well, that was these always turn into really interesting conversations.
Yeah,
You just
that was
never
a
know
good
where
one.
you're going to go.
Yeah.
But she was great. She was awesome. I think that's going to do it, right? You got anything you want to?
Nope, that's going to do it for us. We'll be back. We'll be back next week. Same time, same place.
All right, guys. Take care. We'll catch you next week.